Yo, what's up, guys? It's your boy Looney. Today, I'm breaking down what I learned after making over 100 option trades. The good, the bad, and the lessons that actually changed how I trade. If you've ever wondered what happens when you sell options week after week, I'm about to show you what works, what doesn't, and what I would do differently if I were to redo everything. But before we get into it, quick shout out to the Discord. It is free to join, and I also offer a premium membership for $8 a month that gives you access to one-on-one coaching, trade callouts, my full option selling course, giveaways, and more. All the links are in the description. Now, first off, let's be real. Selling options does work, right? It's consistent, it brings in premium, and it actually compounds slowly over time if you reinvest those premiums. But it's not flawless. And I've done selling options over 100 times. I've done over 100 trades, and that includes covered calls, cash secured puts, and recently I filtered in some credit spreads. And while most of them were actually profitable, I've learned that sometimes consistency can actually limit your upside and could actually hurt you in a bull market or even a bear market. So right now, we're currently in a bull market, and I'm going to tell you how my covered calls are actually hurting my upside and it's overall hurting my portfolio. So if you could tell, I have a lot of shares of Riot and SoFi, as well as Oscar, and we'll even mix in Mara as well. And the issue is they've ran up so much since the April lows. If we look, let's actually look at Riot, because Riot is one of my biggest positions. And if we go to the 1 year chart and we look at April, from here till now, it is up 173%, or that's the 1 year chart. But since the low in April till now, it's up 200%. And with selling options or covered calls, as we're talking about right now, you actually don't want the stock to run up too much. Yes, it is a bullish strategy, but unfortunately, if it runs up too much, you actually run into a sticky situation where you have to decide whether you want to sell your shares, roll your covered calls, or buy back your calls. And the issue is I sold covered calls too much. I did it too close to the money, and I also did it on all my shares. So what I would have done differently is probably done it on a fraction of my shares and left the rest uncovered. And I'm actually paying the toll now, and I am buying back some of my calls because I actually want to own Riot long term, whether it goes back to its original lows or under my cost basis. But what I would have done differently is probably done it on one contract or two contracts at most. And if those get called away, that's fine. I could reinvest that into something else or do more cash secured puts, as we're going to get into in the next topic. But yes, I probably would have done it on a smaller portion. The issue is I was doing it on all my shares. So when Riot ran up and all my shares were covered, unfortunately, I was capped my upside. And when I had to roll, I was paying large amounts. So a lot of YouTubers or a lot of videos you watch, covered calls work, but you need to be very strategic. You need to be doing it on a fraction of your positions. It can't be 100% of your positions unless you're just trading the stock. And I do trade the stock. So again, I'm going to get into cash secured put side. But for example, let's say bull or Webull, I get assigned. I'll quickly switch to a covered call, sell it at a higher delta, and let these get called away because this is a swing trade and I don't plan to hold this for a long term. And same with TSLL, that is the leverage trade on Tesla. I can't find it here. Oh, the $12.5 put. Same thing with that. If I get assigned on my cash secured put, I'll quickly sell a covered call. But on my positions that I actually want to hold long term, yes, I will still plan to do covered calls, but I'll be a lot more strategic with choosing deltas and also not doing it on all my shares. And yeah, I'm doing it now. So something like Open, I have 166 shares, and I wouldn't say this is a long-term play, but I am not running any covered calls. And mostly it's because of my other positions. I'm super hedged, so I don't want to be more hedged to the downside. I actually want to be be able to capture the upside. So something like Open, a very volatile stock, and a very risk-on environment where it performs well. So if we do see more volatility to the upside, this one will most likely do well, or at least that's what I'm hoping. And all that will be good, and that will probably be able to cover up my losses from having to roll my covered calls or just having to manage those. Now, let's go to cash secured puts, because that is the other side of covered calls. Covered calls are when you own the shares. Cash secured puts is when you put up the capital to own the shares. And usually what happens is you do cash secured puts to get assigned and get shares. And then once you have the shares, you could run covered calls. So this is actually one of my favorite strategies, and they do work in any sort of environment, but they work good in, I'd say, neutral to bullish environments. In bearish environments, they still work, but they do play with your emotions, and sometimes just waiting it out for a better entry is better. But again, you can't time those things perfectly. But they are great for buying stocks you want to own at a discount. But timing does kind of matter. I know time in the market is better than timing the market, but after doing 100 trades for at least option trading or selling options, the best time to sell puts actually isn't when everything is green. It's on red days. And this is when usually volatility spikes and fear hits. Sometimes I'll use the VIX to actually decide if I should make a trade or not, or how volatile the market is. VIX recently has been really low, but if we go back to April, we could see that massive spike there. And that was a great time to sell puts. And we'll get into another thing of actually doing some buying strategies and using leaps as well. But when volatility spikes and there's red days, premiums do get a little bit better and a little bit more rewarding. And you also get to own the shares for cheaper. But that's exactly what I'm doing. I did it on Tesla, or the leverage trade of Tesla. I did on Webull and Zeta. Yes, the dips aren't as hard recently because we are in a bull market, and I'm sure they will get a little bit more violent if we do go to a bear market. And you have to also be notable of that, what kind of market we're in. If we're in a bear market, there probably will be more downward direction. So maybe you want to size accordingly. And I am sizing accordingly with this as well. I am doing one trade at a time. Webull $12 put. And then as it decreased, I opened up a $10 put. And I gave that to my Discord. And this one's actually up 40%. And I opened it today. So might close this one out early. We'll see where it trades at open, or just see where it goes. But I'll have to manage that. But when things dip hard, like in April again, this is when you want to be selling puts. When you want to do it on like Riot, SoFi, whatever stock that you're looking at. So now what I'm doing differently is I'm way more patient, not only with covered calls, but also cash secured puts. If the market's rallying right now, I'll definitely be more cautious with selling puts, or I'll go even further out of the money because their prices are very elevated. So when they come back to the norm, they will go downwards pretty ugly. But when things do get ugly, like red days, that's when I'll actually be more aggressive with selling options. Now, I want to talk about the power of leaps. This is another strategy that I do utilize, or I do plan to utilize a lot more. Right now is a bit difficult to do that because we are at such elevated prices. But if you're not familiar, leaps are long-term call options, and they're usually about a year or more out. And they actually let you control shares for less capital while still getting that long-term upside. And you can see I've used them for Riot and SoFi, and they're both well over 100% returns. And I open these less than a year, and I can close these early. I'll probably just let them go, or let them go to expiration and manage them as we get close. But it is worth noting how powerful these can be used. And this would be another perfect trade to use when the market is super red or super fearful. Maybe wait for some support. That's kind of what I did. I did try to wait for some support, so we're actually getting that bullish momentum upwards. And then that's when I started to buy a call, because what happens is you get a falling knife and you buy these calls, and sometimes they fall like 40 or 50%. And the way to manage them is either to buy even more at lower strike prices or do some other trade to hedge against it. But that's a lot more management. So I usually just wait for some support, and then I'll look into buying some leaps. But even SoFi, I didn't time this one perfectly. I did this when it was on its upward momentum and I was trying to catch that. And even still, I got it the break even 1760 and I'm still up pretty significant on this one. But the beauty of leaps is they combine the best of both worlds. You get that long-term conviction like a stockholder, and you actually get the leverage like an option trader. They're definitely not for day trading, but they're for building positions smartly over time. And you can actually, when you do leaps, you can exercise these and acquire the shares. If you actually want the shares, you can. You go to trade and you go to exercise, or it's down here, exercise. And basically you buy the shares and you have to pay for it. So I would have to pay $500 for Riot and then $1,000 for SoFi. Now, here's the fourth thing, and I'm curious to see what I do with this strategy because, again, I want to be cautious and be very strategic because I have been through a bear market and now we are through a bull market. But I have learned that no single option strategy works forever. Markets change and momentum shifts. So what I've been doing now is mixing in some strategies. I do my sell covered calls on positions that I want to collect the income, and unfortunately, they have ran too far. I also sell cash secured puts on red days for steady income. I hold the leaps for long-term names I believe in, but sometimes I'll throw in some credit spreads or even buying some debit spreads to capture the upside. And I try to do these not as much as, or I try to position size these correctly. I'm not going all in. You can see these are only a portion of my portfolio, but I'm doing the debit spreads to capture the upside. It's not an all-in trade. And I'm also doing credit spreads to capture the upside, but also protect somewhat to the downside. It's a really neutral to bullish strategy. But right now in this market, I don't want to be owning shares. There is very little opportunity, or what I believe is little opportunity in the market right now. So I'm simply holding and I'm trading some stocks that I want to be able to capture the upside on the upside momentum. If things go against me, I have that covered calls to protect me a little bit. But if I lose these trades, that's fine. I still keep the shares. I could sell cash secured puts, but I'm doing a lot more of those spread trades to help out, to get those quick gains and play with momentum, because who knows when things get turned around. And I don't want to be in a situation where I'm buying at the top, when I'm buying shares at the top, and then be caught holding the bag and sort of return back to my cost basis. So just to wrap things up, this is what I've learned from trading over 100 options trades. Number one is selling options is consistent, but it's not perfect. Number two is covered calls can cap your gains, and I'd personally leave some shares uncovered, especially during strong markets. Number three is to sell puts on red days when premiums are highest. Number four is to utilize leaps as a powerful way to build long-term exposure. Number five is to actually mix in different strategies to adapt. And whether you want to do spreads, you could even buy calls, covered calls, of course, maybe buy some protective puts, all have their time and place. But at the end of the day, the goal isn't to win every trade. It's to stay in the game and keep compounding. Until next time, peace.